Hello and welcome to the 150th episode of Views from the Market, Midmarket Private Equity and M&A in Canada. I'm Mario Nigro, a partner in the Private Equity and M&A group at Stikeman, Elliott. I'm excited as today marks our 150th episode, and we couldn't have reached it without you, our listeners. Thank you. Over the years, this podcast has connected thousands of professionals and sparked countless conversations. Thank you for helping us grow and making this journey possible.
Now let's dive in with our guest, Ira Goldstein, CEO of Ultraviolet Cyber and founder of Kernel Advisory. Ira, thank you for joining us and welcome.
Happy to be here. Thanks for having me.
We always ask our guests to start the podcast by telling us a little bit more about themselves, and in your case, about Kernel Advisory and Ultraviolet Cyber. So I'd love to start there.
Yeah, so I started Kernel Advisory 5 years ago, approximately, and we're a cybersecurity advisory firm focused on M&A advisory and technical services. And really my journey in cyber has been as an operator, helping large companies and governments secure their data. I did that previously at a company called Herjavec Group as their chief operating officer, and then now as CEO of Ultraviolet Cyber, which is a private equity-owned cybersecurity services company focused on the Global 2000 U.S. federal government markets.
Cybersecurity has become one of those very, very popular, if that's the right word, topic when it comes to M&A at the moment, in the sense that it's one of those areas where 10 years ago, no one was doing it, but now more and more people talk about it, and it's become a kind of key part of M&A. Tell us a little bit about that evolution. I mean, what are you seeing from the evolution of cybersecurity and M&A? I remember 10 years ago, we didn't even ask a question on the due diligence request list, and then now it seems to have its own questionnaire on some type of businesses.
Yeah, so I think you need to divide this into two categories, both of which Kernel plays in and which I see every day. And one is diligence of cyber companies or cyber adjacent companies. And one is cyber diligence, meaning horizontal diligence across any type of company that requires some type of security diligence. So it's almost easier to talk about the second one first, which is, as you said, there was a time when no one really cared about is the data secure or not, or it wasn't as high on the risk register, let's say, from an M&A perspective. And part of that was just because not as many businesses were tech enabled, not as many businesses had data as an important commodity or asset to the deal. And so the risk of that data being impacted or stolen never really rose up to the level of diligence. And then it started to be covered by existing advisors like insurance advisors or legal advisors would include some sort of risk management or cyber diligence there. Even to this day, there aren't a lot of fees for cyber diligence in M&A. Forget about mid-market. I'm talking about M&A in general, despite all of the headlines that you see. There was the big Yahoo acquisition, and that was one of the big landmark breaches that was discovered after an acquisition that was seen to potentially have had a enterprise value impact. And so I think the more times we see breaches take place that have an enterprise value impact in M&A, the more there will be discrete fees carved out for cyber diligence. The state of the market today that we see is that it's typically a generalist IT M&A provider, M&A diligence provider doing some type of checklist diligence related to an existing framework like NIST or some other third-party framework of whether you are secure or not. And unless this is a software acquisition, we typically see not a lot of hands-on keyboard work. So the real way to determine whether someone is secure or not is not just to look at a report or to do a questionnaire, it's to get hands-on keyboard. And so the way Kernel is differentiated there is there's a full spectrum of assessment work as well as technical work that could and should be done as part of M&A diligence related to cyber. And so I think that's one bucket of it. There's the whole other bucket of many companies that are technology companies today, whether they're services or product companies. In many ways, part of the value of their company is based on data and therefore based on the security of that data. And I think that's, again, where there's much fewer participants in the market from a diligence perspective who can actually look at the value of an offering, whether it's product or service, and say, how does this compare? How does this differentiate? And how does it stack up against all the other cybersecurity solutions that are out there? And so at Kernel, the company sees both those sides of diligence.
Obviously, from a mid-market point of view, you're working with a number of different type of companies in different type of scenarios. When you look at the nature of the cybersecurity diligence that should be done, Is there a way of kind of differentiating between, would say, look, for this type of business, you really should be doing, we'll call it the gold standard, or we should really invest more versus, is there a way of kind of differentiating what you call them like guideposts with your experience says, if it's this kind of business with this kind of profile, if it's this kind of business, maybe it's less important. Is there any kind of guideposts you can give so that someone says, if the company I'm looking at has these features, I should be looking at a more evolved, a more substantive cybersecurity diligence program?
So as a cybersecurity practitioner and someone who sees companies on their worst days and talks to CEOs and CIOs on their worst days, obviously my recommendation is to do more upfront. I know that's not always feasible, but if data and information and the networks and systems that house and process that is important as business, both the continuity of this business, like day-to-day operations, but also some type of intellectual property, you need to be doing cyber diligence that's equivalent, maybe not to the amount you're spending with a lawyer, with respect to all the lawyers in the room. Sometimes those fees can run up on a deal, but certainly you look at like a quality of earnings, accounting, and how much you would spend on that. Typically, we see IT and cyber diligence come in below that from a pricing perspective, but not so low that it's just come in for a day and do a 1 day or 1 hour type of checklist. And I think that's where a lot of people get off track. So they say, and you can think about it in terms of a small, medium, large, based on not necessarily the size of the business, but the risks associated with the business. So a small would be, let's just assess what the current state is. Is there cyber insurance? What is the state of their systems? Are they outsourced or are they managed in-house? What kind of controls do they have in place? It's like a scorecard, red, yellow, green, and here's our estimated roadmap to get it up to a standard. That would be a small, and that would be for any type of business that reliability is important to them. Like they need information and data in order to keep going, but it's not a tech-enabled service. The medium would be actually get hands into these systems. Let's see what reports they've had, what third-party assessments they've done. SOC 2 Type 2 is quite typical. ISO 27001 would be quite typical to see whether there's third-party assessments of their security controls, and let's assess those and see if there's any gaps, and that would be more of a medium. And then the large would be, let's get hands on keyboard. Let's actually test the systems ourselves. If there's any software involved in a business, if there's any critical system, even if it's a third-party software involved in the business, you want to get to that large diligence to satisfy yourself that the thing that you're buying is not going to be impacted on day 2 by a risk that you should have known about before the deal. And that's really the key in these diligence engagements to uncover.
I'm always amazed by how many times I hear about cybersecurity breaches in all their forms. When you're looking at, to your point, the profile of spending resources on diligence in the cyberspace, let's take it the other side. What is the risk profile? I'd be honest, I'm seeing more and more breaches, including with smaller companies. It seems to be becoming pretty, but what is the on the ground? You're on the front lines when you're measuring the risk profile of spending resources to do this kind of diligence. What's the other side of the story look like? What are you seeing on the ground in terms of the type of attacks or the nature of attacks, how frequent? I know I'm seeing more, so I could only imagine what you're seeing.
So there is a certain aspect of predictability to this, and I don't mean that in a way that everything is foreseeable, but if you look at the root cause of most of the breaches that take place, and then there are ones that are related to crime, and you see a lot of ransomware or extortion related to unwanted programs or incursions into people's networks. There's a lot of high profile stories about these. And then you look at ones where companies are just getting caught up in some other campaign, whether it's a nation state or could be criminal or could just be something that they got caught up in on the internet that causes their business to have an outage. I think across the board, if you look at it, the incidence of these taking place reduces based on the proactive controls that people invest in. So like hygiene is really important. The brushing and flossing of IT and security. You'll hear a lot of providers say this, and there are ways to prevent ransomware. There's this whole class of software called endpoint detection and response. And you can look at a lot of the major public companies that provide these pieces of software that have been very, very successful because by and large, it's not always perfect, but by and large, if you deploy proactive controls, you can prevent these types of things from happening. I think the reality for a lot of businesses, especially in the mid-market, is that it's hard for them to get the investment dollars allocated to this, what it seems like a cost center. It may be because they don't have the leadership in IT or security to make the case. They may not have visibility to their board of directors. They may not have a board of directors, depending on the size of the company and the ownership structure. The prevalence of the attacks continues to rise, but that doesn't mean the impacts are as bad as they used to be. So the ones we hear about in the news are certainly bad. That's why they made it to the news. But I think what's actually happened in the market is there's a baseline level of protection that's been put in place with the advent of really effective cybersecurity software and services. You just have a mix of haves and have-nots. Those that have made the investments and have deployed these tools and have a really good amount of protection and a really good amount of hygiene that is being managed over time, you still have this have-not bucket. And I think that's where we get a lot of the calls to say, we're in trouble. Can you help us? And again, it's not like it's unclear how to prevent these types of things. It's just a matter of making the investments ahead of time and implementing the controls to prevent these things from happening.
How innovative are these investments? I mean, I'm just curious from a practical point of view for a lot of these companies. Is it the kind of stuff that it's like building a house? You got to kind of building the foundation and it gets stronger over time, or is this kind of the one-time cost where you kind of pay up? And I'm just curious a bit about the.
I think it's a mix of both. It's a mix of both. It's all related to the maturity and the history of your company and IT transformation and IT maturity. It's like any system that you build, whether it's a physical system or a digital system, the foundation needs to be really strong. There are some one-time costs you need to put in place, but the operating cost of cybersecurity control software has gone down from the mid-market because there's a lot of competition. So if you have a company that has hundreds of employees, let's say, and not thousands of employees, it will cost tens of thousands of dollars, not hundreds of thousands of dollars, to implement the right controls to prevent ransomware, for example. It doesn't prevent all types of attacks, but just to give you a sense of dollar value, we're not talking about, this is becoming your largest OpEx bucket in order to implement cybersecurity controls. Is there a way to do it right? It certainly costs more if you wait for bad things to happen, but you have to have a defense in depth strategy, and different business owners take different approaches. Some of them want to make an investment in cyber insurance, for example, have a baseline level of controls, but then not spend more because one of their risk mitigants is having insurance. And the point of insurance is, pay you for remediation in the event that something happens. And so you got to take a defense in depth approach, and that's a mix of controls and things like insurance and people and third parties to monitor your security.
When you're looking at a company and you're trying to determine whether you need to really focus on its cybersecurity policies or infrastructure, are there, and I say this to you from a deal perspective, are things that you would say, if I see this, I'm seeing a company that's heading like it's on the path, but if I see this, I know I need to be focused. This is an area where, is there any kind of showstoppers at the front end where you say to somebody, hey, if you see this, that's a problem. You should be focused more on it. And anything like that that's down. Or alternatively, if you say, hey, I see this is probably a company that's spent some time and resources on it.
Well, I think all M&A practitioners will know that diligence is this delicate dance where you're investigating and you're looking at as much as how people respond as to what they respond with. And so one of the most important things you always want to find out from a security perspective is who's responsible for cybersecurity in your organization. And many smaller companies who don't have a dedicated person, they don't have a chief information security officer, have a very hard time answering this question. Well, the IT guy does this, and the CFO does this, and the CEO does this, but it's really all of our responsibility. Biggest red flag I could ever get at a company is when we say security is all of our responsibility. Accountability is absolutely critical to implementing these controls. And so that's something we look for, is who's really responsible for this. You don't need to have a chief information security officer at various company sizes, as long as you have someone who's really responsible and wakes up every day and cares about security. They don't even need to be dedicated to the security role, as long as they're focused on it. So that's really important to us. Capabilities, whether they're in-house or outsourced, we got to understand what that looks like. And again, it's not a red flag if everything is outsourced, but it matters that you have your house in order and you say, we have contracted this to third parties. Here's the critical part of our business. This is the third party. This is us. the responsibilities are really clear. If the responsibilities are not clear, it kind of ties back to having one person responsible, then that's a red flag for us. And then some third-party validation is critical. A lot of companies have gone through third-party assessments, whether it's penetration tests or SOC 2 Type 2, which is really popular in business-to-business enterprise sales. That doesn't mean that you're secured, but it gives me something to at least review to say that some third party has looked at your security. We're going to then look at those assessments and we're going to find the gaps outside of those assessments and say, we know that at least you have this foundation in place, but what about this? So if you have no third-party validation of your controls, it's a major red flag. And it just means that on the buy side, typically, if you're a buy side advisor, you're going to advise the buyer to do one of those assessments before diligence is over. And I certainly wouldn't want to acquire a company personally without knowing what their security posture is with a third party eye before I do the deal. And so we often get a lot of pushback. I have to say, we're not going to have a lot of exposure to management. We can't really ask too many questions. This is a proprietary deal. We have to be careful. We all know the dynamics in terms of banked or non-bank deals. I think in reality, once you develop that relationship, whether you're on the buyer or the sell side, and it's clear that we're looking to do a deal together here, you want to get to truth very quickly as to what the state of the security controls are so that you can model out what costs they're going to be to remediate them going forward, if any.
You brought up earlier the insurance. I mean, how reliable is cybersecurity insurance? I mean, people use that as a kind of anchor to say, hey, I got that as a minimum, or like you point out, as a kind of almost like a floor for their coverage or floor for their protection. But is it enough? People seem to rely on it a lot. When I hear in terms of backstopping cybersecurity infrastructure policies, what's your experience on cybersecurity insurance?
Well, I think it's become more useful over time as underwriting has evolved. So there's passive underwriting of cyber insurance and active underwriting, and different providers do it differently. Many of them are moving to active underwriting, and it serves as another third-party validation, which is that you, with an insurer who does active underwriting for cyber, meaning they do some type of, it's not only the questionnaire, but it's some type of technical testing that allows them to underwrite your security. So typically they do a scan on the internet, and Coalition popularized this when they were kind of disrupting the cyber insurance market, but now many insurers do it. They'll look on the internet, which I don't know if everyone realizes this, but you can kind of tell on the internet what a company's security posture is based on at least their internet-facing systems. And they'll find out, is this someone we should be underwriting? What is their posture? And so for me, if I'm involved in diligence, at the very least, it gives me another third-party view as to this company's security posture. And there are some minimum benchmarks that have become the norm to enable underwriting cyber insurance, which to me is a good thing. It raises the bar. It raises the floor of controls that all companies need to have if they're going to get this insurance. But as a security practitioner, it's something I need to have as part of my toolbox. But as soon as I get it, I forget about it. And I focus on the actual controls I need to put in place. It's not a control, it's a backstop. It's something that if everything goes wrong, I have it to support me. There's someone else in my corner in the event that it's covered under my policy. So I think it's necessary. It's not sufficient. It's good from a diligence perspective to see because it raises the bar on the baseline level of controls. And, if you don't have cyber insurance, it doesn't mean you have a bad cybersecurity program. It's a complete business risk decision based on the dollars for the premium and the potential risk and payout if you have an incident.
I always ask our guests to tell us a little bit about the kind of, I call it the crystal ball, the future, where they see this going. Where do you think the kind of whole cybersecurity in M&A, in terms of diligence, in terms of the future, where do you think this is going?
So I think there's two trends that I see frequently that we'll see how they play out, but they're interesting to me. And clearly there's a lot of automation and AI enablement out there when it comes to assessing controls. Like if you look at the state of the art in terms of software that allows you to assess a company's controls and what a modern company runs on in terms of back-end systems, email, productivity, software, all of that type of thing, we will get a much clearer picture as part of diligence as to the company's security posture if we can deploy one of these tools. So I think what this means is, from a service provider perspective, service providers need to adopt these tools, the ones that are more AI enabled that can predict certain outcomes from a company's cyber posture, meaning if these certain controls are in place, what is likely to happen from a breach perspective. And I've seen a lot of interesting tools that can do this and they can quantify cyber risk. And so from a diligence provider perspective, I think that's going to continue to be the trend. And anyone who's relying on just paper-based and purely human-based assessments is just going to be left behind over time. I think that same AI boom is creating a much larger attack surface. So as a security practitioner, we call this the expanding attack surface. And really, if you just look at the amount of AI-generated code that's being created and new software that's being created by companies and by people who don't have a software development background, it's an amazing age of potential innovation that is taking place and investment that's taking place. That's just more opportunity for bad things to happen. It's also an opportunity for value creation and great things to happen, but we have to see it through the lens of security. And so I think anyone who's involved in M&A, regardless of whether the business is a quote unquote tech business or not, you have to look at the risk associated with the data and the systems that runs this business and allocate sufficient time and money to understanding and assessing that as part of diligence. And the methods will change over time. And the things you're assessing will change over time, but it's well worth a relatively small investment up front for the potential risk that comes in the future if you don't do it.
I want to thank you for being our guest, obviously teaching us a bit more about what's happening in cybersecurity diligence and some of the issues associated with it, particularly for mid-market companies. We appreciate greatly you joining us today.
My pleasure. Thanks for having me.
Thank you for tuning in to Views from the Market. Stay updated with the latest episodes by subscribing wherever you find your podcasts or visiting stikeman.com/viewsfromthemarket.